pig in the market to make big money. You also have to know when to be a chicken. So it's, to me, it's sort of, knowing that shifting between pig and chicken is really, I think, one of the keys to the difference between a real professional trader and everybody else. This is something like Mark Ritchie, who, is side by side with me daily, and we discuss this stuff all the time. He's really good at that. Him and I both are really good at stepping on the gas. When things are going really well, we'll slam it to the floor and just get incredibly aggressive and make tons of money in just a short period of time. And then we have the luxury of sitting out for extended periods of time and not fighting when, there's all this noise and the market's difficult. And then we're in cash. And I'm always in cash when the market's in a downtrend. I've never been caught in a downtrend ever. Not even when I didn't even know what I was doing in the beginning. In the 87 crash, I was even out. I would at least bend with the market somewhat. So that's the key.
The fact is, most of the money is made in a short period of time, a short segment of the year. The rest of the year is simply staying afoot with the market so that when that opportunity comes to push, for example, the China correction in August, that big drop, you had to have been in the market and consistently in the market and following the same routine all the time to be able to participate in that in any meaningful way. And part of the process of having, a few short weeks of really, really good trades, good returns, a lot of weeks of just grinding along, kind of making a living just like everybody else. But then there's also that rough patch. We call it the rough patch. And I've had rough patches that have lasted anywhere from 2 weeks to 10 weeks. And they come and go with time.
When you understand the nature of probability and what I'm talking about, it actually changes the way you trade and the way you think about trades. So for example, one thing that a lot of traders don't realize is the incredible prevalence of the 90-10 ratio in terms of profit distribution. One thing I like to mention is there's this great book called Trading Risk by a guy named Ken Grant. And this guy, Ken Grant, was a risk manager for a bunch of the top hedge funds in the world. He worked for SAC, he worked for Tudor, he worked for More Capital, a bunch of others. And this guy has seen literally hundreds and hundreds of track records from the best traders in the world, all the managers at these funds. And in his book, he said that one of the things that blew him away is looking at all these hundreds of track records over and over again. He saw this 90-10 pattern where 90% of profits came from 10% of trades. And it was persistent, or even 95-5. And it was persistent across all kinds of styles and markets and long and short and blah, blah, blah. It was just everywhere. So when you understand something like that, a light bulb goes on and you say, there's something probability driven here about how the market distributes profits, and then that influences your expectation and your psychology and a whole bunch of other things.
I want to talk about something that you said that I really loved. You said that the biggest factor in your development as a trader is your experience. What has your experience taught you, and how has it made you a better trader today?
I think that as you gain an experience, you become more discriminating. I mean, obviously, I'm looking to trade where there's a supply-demand imbalance. It might be a swing that's just reversing, or it might be continuation of an existing trend. I want to be on board when there's that supply-demand imbalance, and that's the wind at my back. So I want to have the wind at my back, I think for me, a good part of trading is the leverage that you use, so it's okay to dink around and feel small spots and stuff, but it's just like we were talking about tennis, when your opponent is pulled off court and you have that rare opportunity to put it away, you need to be able to tee it up and play with much bigger leverage. And that's where I think the majority of professional traders will make their true money. It just doesn't happen that often. So the experience allows you to add more context, understand tone and pace and volume, and when you've really got those green light go conditions. Does that make sense?
Mm-hmm. So hard penny versus easy dollar is something that I've termed, and I think it actually goes back to maybe Jimmy Rogers. I think Jimmy Rogers, many, many years ago, I heard him say he wanted to wait until there was money just sitting there and pick it up off the ground. I think, I can't remember, but I turned it into a hard penny versus easy dollar, meaning that, and what I've learned over the years is that there's times where money is made very easily. And that's what, if you're new and you get sucked into, you get into a new bull market, and like we just saw, like you said, a lot of people never saw the other side of the coin. You say, wow, this is easy. And that happened to me. That happened to me in the beginning. My first stock, I bought Alice Chalmer. It was a maker of forklifts and tractors. And I bought it at 4 1/8, and it shot up to like $8 in just in a month or so. When I remember, it went up to 6, and I was like, holy cow. And then up to 7, it was up to 8 change. And I sold it and made like 100% in a matter of just a couple months. And I was like, wow, this is for me. why would I ever work when I could just do this, or put my money in a bank and get interest? And sure enough, I was buying Alice Chalmer at a 52-week low. It was beaten down, and I just got lucky. I just happened to be in the right place at the right time, and I developed a bad habit. And then that very tactic blew me up later on. I thought it was real easy, So, but there are times where money is made very easy, and you're feeling very little heat or pressure on your portfolio. And those are those low vol times where you want to be in the market, be very aggressive. And then there's the hard penny where you work your butt off, you trade like crazy, and you get nowhere, or you lose money. And that's absolutely in a bear market, and even in markets that are bull markets, but you get into the later stage and it gets very difficult, and the volatility picks up. And I'm not talking about just the VIX. I'm talking about the volatility in the individual stocks around breakout levels and so forth. And it just becomes, you're just battling. And when you have that reward, or I should say aggravation to reward ratio is very high, that's a market that I don't want to be in, or I don't want to be aggressive in. That's a hard penny environment. I'm working really hard for pennies. I want to work very little and gain dollars. So differentiating those two is a key. We actually have a model. We call it a STEM model, stock trading environment model, that we grade the environment and then report that model reading to indicate whether we're in hard penny or we're in an easy dollar. Right now, we were in a hard penny. We just upgraded it to what we would call an orange. There's green, orange, and red. And orange is a selective environment where it's still a cautious environment. It's not an easy dollar, but it is an environment that you can selectively trade in. So that's where we feel we are right now. We haven't yet moved into that easy dollar yet. That would be really kind of a confirmed bull market where things are really going well. And I don't think we've gotten to that just yet.
Can you talk about the subject of pressing harder when the opportunity arises and betting bigger when the time is right? Has this been an important factor to your success? And what are your views on fixed position sizing also?
Sure. I think position sizing is one of the biggest factors, if not the most dominant factor, in trading success. If you are a discretionary trader, and it's also, this replicates all across what you see in investing and markets and business and in life. I think that being able to make the very large bet at the right time is absolutely, if you don't have this, the odds are much lower that you will succeed. When you look at how the market distributes profits are distributed on a fat tail basis, meaning profits are not just distributed regularly every day. They're very lumpy. They come in individual, they come along sort of semi-rarely. And this is why I think what I was saying about Ken Grant, he observed all these P&Ls that were 90-10 or 95-5. And Peter Brandt has said the same thing. His P&L was 90-10. You see this pattern over and over again. And what that implies is when a position is really, really attractive, you want to be able to take a very large position. And if you don't do that, then you're at risk of simply getting chopped up or ground to death because the light is not worth the candle. There's a popular trading phrase out there that says, if you worry about the losses, the profits will take care of themselves. And I think that viewpoint is actually very, very wrong. I think it's totally wrong. I think you absolutely want to worry about the losses in terms of having risk management, but also if you don't bet really big when the time is right, then there's not even a reason to be there. And the extra profits from betting very big when the time is right are what makes the whole thing worth it. The other interesting thing about this is that value investors and poker players, those disciplines, and even entrepreneurship all show the exact same pattern of when it's a really great opportunity, you want to make a really big bet. Warren Buffett in the beginning wrote in his 1965 letter, he said, listen, we're willing to put 40% of our whole partnership funds into one stock if it's the right stock. And he made some huge bets. Really successful entrepreneurs have made really huge bets, and poker players in high stakes cash game poker, once again, your profit ratio is going to be like 95-5. Maybe 5% of the hands you play, if not 2%, are going to produce the vast majority of your profits. So you see this happening over and over again, where the big bet is really important. I think that this is actually one of the things that happens to quote unquote experienced traders. New traders tend to trade too big and blow up, and then lose their capital, and then they become experienced and they become super conservative, and they always want to take small positions and always want to be careful with their risk. And then their accounts stay small and dinky forever, and they never really make any money, and they wound up, it's like they're eating stale bread and drinking watery soup. And they never actually make the profits to justify trading. And that's because they haven't mastered the art of making the big bet, which is so, so important. It's the reason why you're there.
I would say that the experience really comes from knowing when something is ripe. I want to know that it's ripe, that yes, I can go in and I can play a full line, or I need to pull in the horns and, not, it's just a modest opportunity, and, when the volume's not there, I probably want to be a little quicker to take profits, and, when the volume is there and the momentum is there, the experience helps you stay with a move. It's recognizing that you caught the big fish. So that's really where the experience pays. I mean, I can make stupid little piddly sloppy trades with the best of them, but I know when I got a good trade on, I'm confident of the fact that the market's acting in accordance with my models. And not only am I really good about staying with it, I'm good at adding and pressing it, and there's very, very, very few times that I will add to a trade.
So it's recognizing the situation, seizing the moment, or staying away from the moment.
Well, you can put it that way. Yes, yeah. Knowing when to stay out for sure. Yeah. That's a good part of it.
Yeah, absolutely.
You constantly re-examine what you're doing wrong, and you tentatively get things right, but you can't really get the dynamic going until you have a little profit under your belt, because it's very different when you're risking your principal than when you're risking your profit. So that's how you get these runs, when you get it right, and then you can risk more and make more money. When you have lost it, when you are doing poorly, you've got to retrench. And even as you get it right, you don't get the performance until you can do it on a larger scale, because risking your profit, you see, is much easier.
It's less terrifying than risking your principal.
Yeah, I mean, the reason we have such a good record is because we never lose our principal.
But the main way that you get aggressive, or at least the way I do it, and I've been doing it now for almost 40 years successfully, is what I call progressive exposure. And it simply means that you're only getting aggressive on the heels of success, of traction. So I take a look at my last 4 or 5 trades, and when I'm first getting in the market, they're going to be very small, microscopic trades, just what David Ryan would call a mental health buy, just to buy something. You get a follow through day, you see the market turning up, you see some stocks setting up, you start buying a few positions. If they start working and I have profits, open profits, closed profits, combination of the two, then I start adding exposure and adding additional names, or maybe even adding to the names that I have on additional buy points. So that's the way you want to do it. Now, the key is, and this is the most important thing, with that type of bending with the market up and bending down when the market's not doing well and moving into cash, what you do is what every good strategy should have built into it, is that you guarantee yourself to be trading your largest when you're trading your best and your smallest when you're trading your worst. And this is a key trait or a key tactic of Bill O'Neill, Mark Minervini, David Ryan, Paul Tudor Jones. Any great trader is going to have a strategy that guarantees that when they're trading well, they're trading big, and when they're not trading well, they're trading small.